Let me now bring on board Sukumar Rajah, Managing Director and Chief Investment Officer, Asian Equities with Franklin Templeton Investments. Sukumar, good morning. Good to have you back on ET Now. How would you map the current market environment? Are you slightly disappointed with the way how Indian markets have moved this year? Despite a benign global environment, Indian markets are clearly underperforming global markets.
Good morning. No, I am not disappointed with the market performance. I don't think we should have too much of short-term expectations or look at the market from a very short-term perspective. I think the market has done okay, and what we would like to happen is the improvement in the profitability of the companies. I'd like to see some more consolidation happen and the profitability of Indian companies improve from the current levels, and also see some improvement in the growth numbers. That's something which I look more closely into rather than the short-term movement of the markets, which will follow the improvement in the fundamentals.
Sukumar, morning. What is the big disappointment? I mean, why is it that we are seeing the kind of weakness that we are seeing for the last many days?
If you look at what are the parameters on which the companies are lagging the expectations, one is of course growth. I think the improvement in growth has been lower compared to expectations. So the trough seems to last longer than many people's expectations. I think that's point number one. Second is there's been a decline in margins for the last few years, and many people expect a margin recovery, which is logical, but the pace of margin recovery again has been weak. It's been slow. So I think these are the key issues, and I think improvement in growth and improvement in margin will depend on improvement in business confidence and also consolidation happening. So these two are something that will change the market dynamics.
Sukumar, so given the kind of macros we are working with, CAD is high, inflation is high, GDP growth has plunged, do you think it will be a while before earnings will recover and we should not expect a meaningful recovery at least in the next 2 or 3 quarters?
I think the correlation between these things that you're speaking about and the earnings recovery, there can be some correlation, but I think the earnings recovery is more of a function of the industry structure. If there are too many players competing and there is excess capacity, I think there's going to be weak margins. If there's going to be consolidation, I think then the margins are going to be better. So while all these macro parameters have some effect, I think it has to do more with the consolidation. And as long as we have improved the consolidation happens faster, then we can expect a quicker margin recovery.
Sukumar, if I look at your last declared portfolio, it has not changed substantially. So are you still of the view that good old private banks, large cap IT stocks and telecom as a group, these are 3 groups which will continue to generate wealth?
Yes, we haven't had too much of change in the long-term outlook of our key holdings, and we believe that in no given year we expect large-scale changes to happen. So our portfolio turnover will be on the lower side compared to our peer group, and I think the key holdings, we are monitoring them on a very regular basis, and we continue to have confidence in their ability to deliver good return on capital.
Are you comfortable or are you happy to pay such a strong premium to quality, because the names which you own are Infosys, HDFC Bank, ICICI Bank, they are not the cheapest stocks in the town?
what is cheap is not necessarily something which has a lot of value, and the stocks which have a lot of value are not necessarily cheap in terms of PE ratio or price to book ratio. So we look at the long-term ability to generate free cash flow, and so we have our methods of determining value, and as per our valuation metrics, we find value in these stocks.
So just a follow-up question on the cash flow point. You have a large exposure to Bharti, and currently it is highly unlikely that Bharti will generate a lot of free cash flow. So what makes you bullish on Bharti, where it is evident that in the near term there are not one but several regulatory challenges?
As I said, we look beyond 1 or 2 years, and that is very important as a stock market investor. It's very unlikely that in any stock that the cash flows of the next 2-3 years are going to be a very substantial portion of the price that you pay. So you are necessarily, when you're buying a stock, you're necessarily buying cash flows into several decades. And so we have to look at what are going to be their margins and free cash flows for a period of time, and that is going to be determined by their relative position in the industry. So we believe that they are competitively positioned, and there are too many players, and many players have to exit because they are burning cash and they cannot keep burning cash for long. And as the consolidation happens, I think the return on capital of Bharti is going to be very respectable. So I think that's one of the assumptions that we are making. And so far, we believe that there's no reason for that assumption to change.
Sukumar, soon we would be knocking with earnings, and come 12th, it is in fees turn. Do you think that has the potential this quarter to actually lift the mood of, if not the market, at least the IT pack even further up?
It is a possibility, but the feeling I am getting is, people are trying to read too much into small changes in numbers. It doesn't really mean much from the long-term potential of a particular company. As far as IT companies are concerned, I think what is important is their ability to stay competitive in a situation which is becoming more adverse for many of the companies. As I mentioned before in some of the programs, the growth rate expected in future is going to be lower because the market share of Indian companies is already pretty large, and also I think there are many of them competing with each other on price, because of which margins are under pressure. So we have to assume declining growth rates and declining margins for the sector as a whole. The companies who can mitigate this have to have a strategy of moving up the value chain and offering a better value proposition to the clients. So the companies which can do that can hold up better. The companies which cannot do that will still have profits, but the rate of growth of profits and free cash flows might be weak. So we have to look at companies in this context, and one quarter, while it's a one data point, it doesn't make or break the company.
Kumar, one wrecked space is the entire metal space. In the past, you've taken big bets in the metal space, and your erstwhile favorite is Hindalco. At the current juncture, are you tempted to revisit global cyclicals, especially metals?
Materials in general, I think we see a structural decline in the demand-supply equation. China has been a primary driver of growth and demand for various materials, and construction in China has been a key contributor. We think that the Chinese demand growth is going to be in low single digits on an average over the next 5 years. And it's possible that for many categories the demand might peak by 2020 or so. And a lot of mines are still expanding based on the current levels of profitability and the rapid growth in demand that the sector has seen in the last 10 to 15 years. So it's possible that demand supply might become adverse and the profitability of mining and materials companies might be under pressure. So we have to look at companies only in the top quartile in terms of cost structure, the ability to allocate capital with a lot of discipline, and take tough decisions from time to time. So the companies which fit the bill will can still fit into the portfolio, but I'm afraid generally I think the opportunities in such sectors are going to be limited.
Sukumar, really appreciate your time, and thank you for your wonderful insights, and I certainly hope to see more of you going forward in this financial year. Markets, what do we have there? 57 points down.